Yeah.
Guy Spier, I really appreciate your time, like I mentioned.
And Trevor, it's a pleasure to meet you, especially it seems like you and your brother are fellow coffee fiends. So it's always nice to connect with a coffee fiend, even if you are on the other side of the planet. And with that in mind, I wanted you to see the coffee cup that we recently made, actually, and it's got some good coffee in it. I'm just going to show you here. So
That's awesome.
life happens, coffee helps. I don't know if you saw that. And I'm just going to take a sip, actually.
I think that would be a great motto for the world we're living in right now.
And then on the inside of the cup, I don't know if you can see this, it's got a T.S. Eliot quote. I have measured out my life in coffee spoons, which I thought was rather fun. So, yeah.
You are the managing partner of Aquamarine Capital. What is Aquamarine Capital?
Well, it's an investment firm that I started now almost 25 years ago, not quite. Started with, as Mohnish Pabrai would say, friends, family, and fools. Starting with my father and two business partners of his who had excess cash to invest. And I had never been even an investment analyst before, far less an investment manager, but I was deeply enamored of and with Warren Buffett, Ben Graham, Berkshire Hathaway, all of those things. And I took their money and started investing it. And now here we are 23 years later. And the initial pool of capital has grown to 350 million. We've gone from 3 clients to 150 clients. And at some point I started that in New York, but now I've moved to Zurich, Switzerland, which is where my home base is. And life is good. Life would be good if it wasn't for watching what is going on about 1,500 miles east of us. Mm-hmm. It's very distressing to see what's going on in Ukraine right now. So,
you also read a very successful book, The Education of a Value Investor. Do you remember when you started to become famous in the investing world?
Well, I think the book probably had a lot to do with it. The other thing that would have had a lot to do with it is my bidding with Mohnish Pabrai to do a charity launch with Warren Buffett that put us in the news a little bit. And but the book is kind of like an anti-investment book, if you ask me, because rather than go into my successes, it kind of goes into my failures. And in a certain way, part of my motivation, Trevor, for writing the book was to kind of try and help people to see that any successful life comes with an enormous number of setbacks. And I really wanted to write about those setbacks and how I got through those setbacks. The very strange thing is that I have people in my family, even people quite close to me, who know that I've written a book. They don't want to read it. And they're coming across adversity in their lives. And it kind of wrote it for people like that, especially people in my own life, so that they can see that I'd come across adversity and they can see how I handled it. And they come to me, Trevor, and say they want my help, but they don't want to read my book. So in a certain way, I really appreciate you having read my book, because there are people that I interact with on a relatively regular basis who just don't think that it would have anything to teach them. So, thank you for reading it.
Amazing story of authenticity also.
And, for the listener, just before I came on to, just before we hit record, I told the story of basically a man who does extraordinary things in getting across a river filled with alligators that he successfully wrestles and protects himself from. And, when he's asked more or less the question, and Trevor, I'm varying it slightly, but the point is the same. Hey, that's incredible. How did you do that? His answer is, I don't know how I did it. Somebody pushed me. And in a certain way, just to give you a sense of the authenticity of the book and the writing of the book, the push for me came from somewhere having a couple of peers who'd written books, especially Mohnish Pabrai, the sense that if he'd written a book, I could write a book. And but then suddenly I woke up and I had a book contract. It's kind of a scary thing. I'll tell you an amazing story, actually. The woman who helped me get to the point where I had a book contract is actually from Calgary, Canada, or she's not from she was living in Calgary, Canada. Her name is Jessa Gamble, or Jessa Sinclair is her maiden name. She goes by both, and she's normally a science writer, and I met her at TED conference in the UK. But when the book contract landed on my desk and I knew I had to sign it, and they were paying me what I felt like was a substantial amount of money to write the book, but I hadn't written it yet. And then I went through, a bit like the guy with the crocodiles, enormous fear and enormous stress, because I had made a pact with myself. I was under no doubt that I would deliver a book. I did not want to die not having published a book, put it that way. And so this was my chance. But I did not know whether the book, first of all, I might have delivered a manuscript that was so bad that the publisher wouldn't accept it. It was also possible that I'd write a book that's not great, that's just mediocre. And so, so I asked myself the question, how can I write a book that will really make a difference on the planet? And I think that if you're Daniel Kahneman, and you have this extraordinary knowledge, you've been a professor, you've been doing a whole bunch of research, you've been immersed in these really amazing conversations with all sorts of people, then you have real academic experience, and you have knowledge of something, that you have authority to write about that. Or another person that I admire, Neil Ferguson, who's just the most amazing historian. So you can write about external things, but what I got to pretty quickly, which was a correct conclusion, was that the only thing that I could really be authoritative about was myself. But actually that was a good subject to write about. And, it's funny, I'm giving a talk tomorrow in front of a crowd of university students at St. Gallen University, one of Switzerland's leading universities. And I have that kind of turning in my stomach, slight nervousness about doing that. And I know that what will save me is that I'm going to be authentic with them. One of the introductory things I'm going to say is, I'm going to say, look, to put them in the right frame of mind, I will tell them, in order to put you guys all, I understand there's 160 people going to be there. And I'm kind of scared of them because they're super smart. They're the cream of the crop of Switzerland and Germany. I'm going to say, your job is not to take dictation from me. Your job is not to take notes as if I know what I'm talking about. Your job is to know something about me and to observe me as an actor in the financial and economic landscape, and then draw your own conclusions. And I'm going to help you to do that by revealing as much as I can about myself so you can set me in context. And effectively, that's what I did in the book. I think it's really, really important, because when we don't reveal ourselves, people can't draw the correct conclusions. And I think that I've read, Trevor, too many biographies, autobiographies, which are basically puff pieces, but the author and or the biographer does not step in front of the audience and say, hey, what you're about to read is a puff piece. Here are the bits they left out. And the bits that they left out are probably the more crucial ones. And most people have these enormous egos and they're not willing to do it. I'm not saying that I don't have an ego. I certainly do. But I was just blessed with the fact that I'd read, I was blessed with two things. First of all, I was lucky in picking a wife who helps keep my ego in check, which I think is really, really valuable. And I just read Mahatma Gandhi's autobiography, which had a huge influence on me. And he was somebody, for all of his faults, and Hitchens, it's not Peter Hitchens, but his brother, who's no longer alive, has been highly critical of Mahatma Gandhi, as has George Orwell. George Orwell did not think that Mahatma Gandhi was this great spiritual leader. He wrote an essay talking about how Mahatma Gandhi was a bit of a cunning politician, was his view. And have an enormous amount of respect for George Orwell. So, author of 1984, I'm no expert, but my experience of reading Mahatma Gandhi's autobiography was that I was shocked at the kind of disclosure that he gave to the audience. I mean, can you ever imagine, Trevor, if you'd ever visited with a prostitute, writing about that in your autobiography, and that's the level of honesty and clarity that Mahatma Gandhi wrote his book with. And the subtitle of his book is "The Story of My Experimentations with the Truth." And there was just a really interesting subtitle. And I'd also read another book. Again, both books brought up at this amazing lunch that I'd had with Mohnish Pabrai by a guy called David Hawkins, Power versus Force. And I feel like, in a certain sense, your reaction to the book, I mean, you held it up and showed it to me, is that, and for the audience who don't have the time to go get the book, the basic argument of David Hawkins is that when people are being honest, genuinely honest, when they're talking truth, there is power to that. And the recipient knows that there's truth in what they're receiving. And to use David Hawkins' terms, they go strong. And according to David Hawkins, that is a physical reaction that's measurable. I don't know that I agree with that, but there's something about when you're in the presence of somebody who's profoundly truthful that you feel good in their company. And I would argue that you probably, if you're like many of the people who read the book, you know that this is the real deal. You know that I'm not trying to manipulate you into believing something about me, which would be the opposite of truth or power. So I don't know if that was luck. There's this amazing idea that has come to my mind a lot recently: when the student is ready, the teacher appears. And exactly how the universe contrives to pull that together is not entirely clear to me, but it seems to me true in so many places. And so somehow the reading of those two books and the writing of my book kind of came together at the right time. But, lastly, before I hand the mic back over to you, there was a moment that I know where I was. So I'd written about my experience at D.H. Blair, and the D.H. Blair, for somebody who hasn't yet read my book, was this Wolf of Wall Street investment firm that I went to work at after business school, in which, they would have been good friends with Vladimir Putin. Anything, whether legal or illegal, but if it made the money, they were interested in doing it. Pretty nasty place to work. And I left, I had a terrible moral failing in choosing to go work there. And I had my reasons, which were bad reasons. I was young, inexperienced, and did not have a good moral compass. And why was I telling you that story? Yes, because I know where I was when I realized that I would have to put that story and put a chapter about D.H. Blair into my book. And so a certain amount of, so to be truly honest with oneself and the world requires a certain amount of courage, and that pays enormous dividends. Courage because you have to take a risk, but pays enormous dividends. Back to you.
One of the sections in the book kind of outlines how you got started with your dad, who is also a successful businessman. What's the best advice he ever gave you?
My father was born in Israel to German Jewish parents who left Germany in the 1930s because it was no longer a place for them. And he grew up in Israel on a chicken farm and served in the Israeli military. And I remember one of the things, because I was going out, I was not some boy born into an investment banking family or into a family of lawyers or people who could give me some guidance in the investment world. But I can remember him talking about how, I should check my flanks. So as I go in a certain way, you kind of like, you go a metaphor for life. And it's not, it's not the right metaphor for all circumstances, but it's certainly a metaphor for some circumstances. Check your flags, see what's left and right, proceed slowly and with caution, basically. And I've proceeded, I would say, in comparison to many other people that I know, with far more caution than was necessarily warranted. And in spite of that caution, I have every now and then had my head handed to me. I've been caught in an ambush because I'd not sufficiently checked left and right. Not every investment of mine has been a success. But it's an amazing aspect of the investment world. If you can get 2 or 3 things right, then, in my case, all sorts of proceeding with too much caution, checking too many times, as well as a whole bunch of other faults, all diminish in importance relative to the overall goal of compounding and getting that thing right. And if you get that thing right, it's okay. But that was one piece of advice that he gave me. I think that something that I've been able to change in his thinking and the thinking of our family and the way I approach the world of business is that, my father grew up in Israel. We lived in Iran. He was an employee of a German multinational chemicals company in Iran. And then we moved to the UK. And when you live in corrupt countries where the rule of law is not necessarily well set, where insiders have an institutional advantage over outsiders, you can't. Well, you have to understand that there are the rules as they're written down, and then there are meta rules, and you have to kind of be sharp, and you have to perhaps do deals on the side with people, and it's not a particularly nice environment to work in. And I think that it's the kind of environment that all the guys who are Putin's oligarchs would have had to play in. They would have had to do site deals, wheeling and dealing. And it was really only when I got into the orbit of Warren Buffett that I really truly understood, in spite of having been educated in the United Kingdom and having studied in the United States, that I really understood that in certain countries, and only in certain countries, you actually want to play 100% by the rules, not 99% by the rules, not 99.9%, 100% by the rules. And I think that it's partly an immigrant mentality. It's partly a mentality of people who've been kicked around by history, in various ways, the way the poor Ukrainians are being kicked around by history right now, and some poor Russians. I feel very bad for some of those soldiers. And for anybody who's interested, because this may come out whenever it comes out, we're recording this 10 days into the Russia-Ukraine war. And I can tell you, Trevor, as you can see, it keeps popping into my mind. I can't help thinking about it all the time. But, to play 100% center court, which is something that I think it's Don Keogh. He was the late Don Keogh. He was the director of Berkshire Hathaway and of Coca-Cola. And Mohnish Pabrai got me also thinking about this. The idea is that 99% of playing by the rules gets you 50% of the way. And it's only that last 1% that gets you the 100%. So the last 1% is where all the value is. And it's actually being, just going straight through. And I'm amazed at how long it's taken me to really, really sort of like take that on 100%. And so, yeah. But so that's been an interesting journey for us. And what I would say, Trevor, is that there are, unfortunately, only a few countries where you can do that. They tend. So I saw a chart recently that showed that the countries of the world that are democracies have actually declined, the number of people living in real democracies, according to whatever institute this was. But I would tell you, you can more or less count the number of countries that you can take that approach on one hand or two hands max. And they include all the usual candidates: Switzerland, Canada, United States, United Kingdom, Australia, New Zealand, and a few others. Some other countries in the European community and the Scandinavian countries are probably okay, but there are many countries that are not. And so in those countries, life is far more difficult, because if you play by the rules, you may not get very far, and that can be a very frustrating thing. But, you know, and in a certain way, my philosophy of life, Trevor, before I hand the mic back, is that if you're living in one of those countries, that short list, congratulations, you've won the jackpot. You're one of the you're a small proportion of the world's population, and you can play by the rules. And you'll be living in a country that, even, you know, with the basket case of the United States healthcare system, you will be taken care of socially if you fall through the net, or if you fall off, there is a net to catch you, and playing by the rules will allow you to succeed. But then the vast majority of countries, it's a very complex interplay between the rules and, as my father-in-law would say, who's Mexican, the rules behind the rules. And I think that if you find yourself in one of those countries, you know, my goal in one of those countries would be to get to one of the short list of countries I've just talked about, and to live my life in one of those countries.
You spent more time with Warren Buffett than the average person has. A few years ago, you won a lunch with him and got the chance to start a relationship with him. What's the best advice or lessons he's taught you or you've learned from him?
Yeah, and you know, we could take 8 podcasts over this. And so just to give some background, in 2007 or so, Mohnish kind of said, hey, I want to bid on this lunch with Warren Buffett. Do you want to join me? And I first thought, this is a ridiculous thing to do. But he kind of convinced me that it wasn't about an expensive lunch. It was actually giving money to a charity and saying thank you to Warren Buffett. And so we got to spend 3 to 3.5 hours with him at lunch in Smith & Wollensky's in New York, in a kind of semi-private room right next to the kitchen, which is a room you can visit, by the way. And there's a plaque on the wall for all the people who've had lunch with him there. And so my name's there, Mohnish, and my wife's name's there. It's kind of fun. I've only been back to that table once, but it's a fun table to go visit if you're at Smith & Wollensky's. And one thing that I would tell you at the outset is that I think that there are very few things that I've learned that are sort of like helpful in business, that as I learn them, or as I realize that I've understood them, I instantly think, yeah, but Warren already knew that. So I'm kind of would be curious to see if at any point in my life I get to a point where I can say that I've learned something that Warren Buffett doesn't know. And I'm not sure that I've gone to that. And I'm not sort of saying, you know, the name of my children or something like that, but kind of like life wisdom and lessons. Mm-hmm. And one other correction that actually has a piece of wisdom and help for the audience. I mean, I can say, if you said that I have a relationship with Warren Buffett, I would say that there must be, so I'm not, you know, at the Berkshire Hathaway meeting, you know, there, let's say I'm one of 50,000 people, and I'm pretty sure, reasonably sure, he's growing older. I don't know what his memory's extraordinary. Yes, he would recognize me, and he might, if prompted, remember my name. And I do have sort of like short, I have 2 or 3 interactions with his assistant, Debbie Bosanic, every year. And directly with him, I mean, the last time I had a direct interaction of him might have been 3 or 4 or maybe 5 years ago. So to claim that it's a relationship, you know, like husband and wife, it isn't. And it's not like I could call up Warren and say, yo, Warren, what's up? Want to shoot the breeze with me? But there's an interesting point there. But it is a relationship. And this year he sent me a lovely holiday card. I was super excited to get it, and kind of blown away, actually. So what is the relationship? And because I think that there's something that the listener to this podcast can perhaps take away. So when not long after the launch, I'd studied with David Cameron, was a tutorial partner of mine at Oxford, and he was candidate for prime minister, and so Tony Blair was still the prime minister, and he wanted to bolster his economic credentials and felt like a meeting with Warren Buffett would be a good thing, and was looking to connect to him. And so another friend of mine from Oxford, who was then chairman of the Conservative Party, and they were close buddies, the chairman of the Conservative Party reaches out to me and he says, can you connect me to Warren Buffett? And so I kind of, I felt like this guy is the future prime minister of England, of the United Kingdom. I thought that was okay to do. And I did write, Warren doesn't have an email. I did write to Debbie saying, look, this guy might be and they actually engaged directly. And that was probably fine that I did that. And then about not long after that, another friend of mine who had a business deal that he wanted to try and convince, I don't know, General Electric, where Berkshire Hathaway, I believe, owns some shares. And he kind of pushed me, and I felt loyal to my friend, and I sent it along. And I got this, so I was copied in on an email from Debbie back to my friend, which said, basically saying to him, you don't need Warren's help to get in touch with this guy. If you have a compelling deal, get in touch directly. Don't waste our time with this. And I remember talking to Mohnish about this, and he sort of said, yeah, Guy, the halo of friendship was diminished ever so slightly. And it's part of Mohnish Pabrai's brilliance is that he's got these extraordinary insights into human nature. So what's my point to you? I can say I have a relationship with Warren Buffett, but that relationship would get turned off extraordinarily rapidly if I start abusing it, to the degree that I am beyond careful on anything that might take his attention. So first of all, I would never address anything to him. Or if something was addressed to him, I would put a cover letter on it. And I've done this many times. And I will say, Dear Debbie, for example, from my annual report, Dear Debbie, see attached my annual report with a cover note for Warren. I entirely trust you to make the choice if he should see it and when he should see it. Warmly, Guy. So I'm doing a number of things there. First of all, I'm empowering his assistant. And that's really, really important. And I'm trusting her. So the last thing you want to do is don't want to land in somebody's consciousness when they don't have bandwidth for you, because it's just not a good look. And they will downgrade their friendship with you, if there is any friendship, very, 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 very rapidly. And so why am I taking time to tell this to you and effectively to the audience is that don't underestimate how annoying it is for a person who's busy, for somebody else, in the guise of friendship or in the guise of they have a right to be in touch because, say, they had a charity lunch with them, to want to kind of take their time when they're indisposed. And simply respecting somebody's time and respecting and understanding what they're looking for in life and only showing up when it's helpful to them is a key part of any relationship, but very especially when there's a huge difference between the circumstances of the person that is on the other side of the friendship. So, and that can occur in many different circumstances. And before I finish up and listen in to the next question. So here's the circumstance in which I'd be willing to pick up the phone and call Warren directly and expect to receive him on the other end of the phone. So I'll give one example, a specific example that is unfortunately vanishingly unlikely to happen. But I live in Switzerland, and the trustees who control IKEA, the world's most incredible furniture brand, and are kind of like a Costco to the furniture industry, and would be an amazing addition to the Berkshire portfolio, substantial business, you know, Nebraska Furniture Mart on steroids, all those good things, 1,000 reasons why IKEA would be an amazing acquisition for Berkshire. I don't know, their sales are about 20, 30 billion a year. I don't know what the company would go for, but it would be a sizable acquisition for Berkshire. And so, you know, if for by some miracle, the brothers who control that trust were in my office and they were saying, yeah, we'd actually love to sell the company to Berkshire Hathaway. And here's the price that we'd be willing to take. You know, so now I have what Warren has talked about in his annual letters. I mean, this is not something personal to me. I have a price and I have a company. And then I would call up Debbie and I'd say, Debbie, I got the guys from IKEA in my office. There's a price. They're interested in selling. Can I put Warren in touch with them? And by the way, I'll give just a little bit of background to Warren before he calls them up directly. Is that okay? And then I would say, Warren, you know, here are the 3 things you need to know. And now I'm introducing you. Simple as that. So that would be a reason to get in touch with him and take his bandwidth, because that's what he's focused on. I've gone off on a slight tangent, but for me, it's a valuable tangent, which is, so that's kind of meta knowledge that I learned around the whole interaction with Warren Buffett and the launch, which was that I'd never met a billionaire before. I don't think I had, and not somebody who was so sophisticated at being a billionaire and being so sort of like country bumpkin and down to earth at the same time. And so I learned an awful lot about how to be around excuse me, people who are extraordinarily rich and successful. And, you know, it's about interfacing to their PAs and being upfront about why you want to be in touch with them and only taking their time when it's absolutely necessary. And I spend some of my time with interns trying to get jobs. And I try to share with them that they need to think of the CEO or the hiring manager that they're writing to not differently to the kind of dynamics that I explained in the relationship that I have with Warren Buffett. You know, I don't think you can call it a friendship, if you like. Warren's not calling me up saying, Guy, what do you think of this or that? So, but then lessons at the launch itself. I mean, we could go into so many, and some of them are in the book. Excuse me, I'm recovering from not COVID, but some kind of cold that gave me a cough. And the cough is kind of persistent, which is bothering my wife and my staff. But so a couple of lessons from the launch itself. You know, nothing pops into, of the many things I could say, nothing specifically pops into my mind. What I found is that I do think, obviously we can watch Warren on all sorts of YouTube videos and elsewhere, which is really amazing. What an amazing service YouTube is. And but way better than that is to show up to Berkshire Hathaway meeting where you can join 50,000 people of the faithful in a room with him. And it's a very, very special experience. And you know, I don't know what units one's measuring in, but watching him on YouTube versus being an OMA, I would kind of say a 1,000x improvement. And I would say being with him with 50,000 other people and being with 8 of you around the table is, I don't know, maybe another 1,000 improvement in whatever unit of measurement it is. Why is that? Not because the specific lessons are necessarily different to what one would have in from watching him on YouTube or being at the Berkshire meeting, but because those messages are more powerfully drilled in to me. So, you know, I'm sure that you've experienced being in a theater, either a movie theater or the opera or a concert or a play. There's a huge difference between sitting in the first 2 rows than sitting at the back. In the first 2 rows, the drama fills your field of vision. You're right there, almost in the drama. Whereas, you know, when you're sitting in the back row, you're still present in the room, but somehow it's not the same. And so I think that being with Warren in the same room and experiencing the same man who shows up in all these other places helped me to drive the lessons of Warren Buffett that he has for all of us far more powerfully into me. And so I learned the things that I needed to learn through studying him far better than I would have learned them had I not done that lunch. And then, so that is the real value. And so what is the takeaway for your audience, Trevor? I would say that the takeaway is when you really admire somebody, look, Charlie Munger says, make friends with the eminent dead, so they don't even have to be alive. That's fine. But if they are alive and you're like, sort of, oh, am I really going to fly all the way out to a Daily Journal meeting in Los Angeles? I can just watch it online. And the answer is, yeah, make the effort to fly out. It will be better for you. You will learn more by having flown out there. And if you can have lunch with the person, do that. Make that extra effort, even if it costs an enormous amount of money. That was a valuable investment for me. And then just a couple of, these aren't really lessons, but just the experience of being in the room with him. He is, at first, he was super enthusiastic to see us. And that was really Mohnish's work. Mohnish had made sure that he understood that we were there to thank him, and it was a family event, and he was super excited about that. I think that he kind of has some kind of like Asperger's, or, he's, all of his human interactions where he kind of, I had the feeling that he learned to do that. It didn't come naturally to him, if you like. But he was really, really good at it. And but it's not, there are some people who are naturals at it. He's not a natural. He's just an unbelievably smart guy who studied those things through that famous course, the Dale Carnegie course. So, but he'd studied it, and you could kind of see that. And then, I felt like, Alice Schroeder, who's one of his biographers, has confirmed to me that she feels the same way. You feel like that the guy is, so I'm talking, let's say, and Warren is there listening to me saying, oh, this is fun. And I wonder which way he's going to take the conversation. And there's 3 different places you could go here. I wonder which one he's going to take. Oh, he took that one. And there's a kind of a light in his eyes. Is okay, he did that. Okay, let's go there. And so there's this kind of like brain that is just moving at a far higher clock speed than, say, my brain could ever move. And that was at once kind of exhilarating, but also a certain kind of disappointment, because all the way up to that moment, I had held on to some kind of vain hope that I would come out of that room saying, yeah, I'm as smart as he is. And I don't feel like I can say that, which is kind of slightly painful to me, because I would have, I don't think I lack on the IQ points, but geez, I'd love to have the extra IQ points. And to hear Warren Buffett, he kind of is willing to give them away. He says, you don't need the extra 20 IQ points, to which my answer is, well, give them to me, Warren, if you don't need them. But back to you, Trevor.
It's kind of like being in a room with Elon Musk or something, trying to keep a conversation with somebody like that. It's maybe you can do it, but you realize there's a lot more going on in the background.
Yeah. I've drunk the coffee now, so I'm going to go to water, if that's okay.
Yeah. You are a fund manager, and you take care of people's money and whatnot, and you've been very successful at it and consistently beat the market. How many people do you see consistently beat or outperform the market?
Well, thank you for your kind words. I can't say it's been consistent, and we still have an outperformance against the S&P net of all fees. But in the last 4 years, we've underperformed the S&P. The S&P has been extraordinarily difficult to beat. So, and then so just correcting you there, and then your question is, how do you do that?
Well, how many people do you see actually do that?
So I think that what's really interesting is that the average life of a fund is like ridiculously short. It's kind of less than 5 years, probably. And there's a sort of like a the dirty trick or dirty secret that's played by the large mutual fund complexes, in which they fold the unsuccessful funds into the successful funds. And so you kind of have a track record graveyard. And if I don't know if you have any kind of mathematics background, but the thing that explains this, and I hope you don't mind, I'm going to dive into, I'll finish my point, then I'll dive into it. So there's a concept called ergodicity, which is, I can't claim to understand it mathematically, but I can understand it enough that I believe I can explain it to your audience, or at least start explaining it.
I think that's Taleb, isn't it?
Nassim Taleb, I don't know if he talks about ergodicity. There's a guy in London of the Mathematical Institute who's given a number of talks about it, and I really ought to remember it. But Nassim certainly understands ergodicity very, very well. And I'll explain it in simple terms that I can understand. And hopefully I explain it well enough. But so this concept of folding in bad performing mutual funds into the good ones is something that happens all the time. And I actually don't know of very many funds that have a continuous track record for the amount of time that I've had. And, all you need to do is compound at a reasonable rate for a long time, and you're going to do extraordinarily well. Having said that, so my fund has just gone over a 10x on the original dollars. So $1 invested with me is now 10 times that. There are a number of funds that I know that have reached 10x in a far shorter time, and so in a certain way they might be comparable. Of course, what you never know is how much risk did the other guy take, so I don't know, very few. If you allow me, I'd love to just go into this idea of ergodicity for a second. Mm-hmm. So the idea is that it is actually shocking that it is not in your average finance textbook. But what we need to talk about is a time average and an ensemble average. And so we can take a simple game in which you flip a coin, and if you get heads, your portfolio is going to be up X percent. And I want to get the numbers right, and I could look it up, but that's probably not a good thing to do on a podcast. And if you get tails, it goes down. And the average of those is plus 5%. So you'd say, well, the expected average on each one of these things is plus 5%. So, the expected average is day one, I'm at $1, and then I can expect at day two, I can be at $1.05, and then, and it will continue to compound at 5% every throw. And so if you actually play that game, with a starting number of 1, you go to 0, and I can share with you the calculations afterwards, and you can put them into your show notes. And this was utterly shocking to me. I said, how is this possible? And so what you get is, if you do if you have 1,000 coin throwers playing this game at day 1, and then you have them all, let's say, play 100 of these, there'll be some who win extraordinarily big. They'll throw a series of heads every time, and that will take, but the vast majority will bring that average down such that you have the thing growing at 105, but it's because of a very small number of incredible outliers at the top. And the problem is, if you're a guy who starts your coin throws at the beginning, you don't know which one of those 1,000 you're going to be. Are you going to be one of the kind of like very small number that have an extraordinary number of heads or are you going to be one of the other guys? So the ensemble average of that thing is growth at 5%, but it's only because of a few extraordinary outliers at the top. But what we need to look at when we start our investing lives and we look off into the future, we can't automatically shift into the one that did really well. We can only go with what we are today. And so the kind of averages that we want to look at are the time-based average, the average of all of your specific throws. And in this game, as it's set up, all of your specific throws are, 99% likely to lead you to a ruinous result. And so that's kind of theoretical. I don't know if I explained it very well. I can certainly do links, send you links that will explain it far better than I've just explained it. What's my point? If I take the guys who've done a 10x on their investments, so my goal is to not play games where I need to be in a small minority for it to work out really well. And I don't know up front. I need to play the games where I have no doubt that it's going to work out okay for me every time, because the big losses will just wipe you out. Even a big number times zero is zero. So you basically should never take zero, any bet that is got any chance, even the most minuscule chance of giving you a zero, which might be a sort of kind of simple idea of doing it. You could have the guy who's picking up pennies in front of the steamroller, which is another way of expressing this idea. And out of 1,000 guys picking up pennies in front of the steamroller, some are not going to get caught in the cement, and they'll actually have a good living. And then, but a certain number of them are going to get rolled over by the steamroller. So which game are you playing, and what game are these other people playing? And actually, can I be sure that I'm playing that game is kind of like a really, really hard question, but is an absolutely critical question to ask. And what's my point to the group if you just got totally turned off by this ergodicity idea? And Peters, the ergodicity guy's name is Peters. I'm so sorry, Trevor. I just want to look it up.
Yeah.
He's a German guy, and Ole Peters. He's got a website called Ergodicity Economics, and there'll be other simpler explanations. But what's my point to anybody listening to this podcast is, do not be upset if your investment results are just okay and they're not hitting it out of the park, because the goal is to be able to do whatever you're doing that gives you okay investment results consistently over a very long period of time. That consistency, the tortoise is going to beat out over the hare. And that's kind of like you have to be patient, I guess, is just the simple idea. And in my case, a certain sufficient understanding of numbers and probabilities, but also a healthy amount of fear, has kept me far away from the kind of things that can wipe me out, but not enough far away that I haven't had one bankruptcy in my portfolio, just to be clear. So in any case, back to you. I kind of, as you can see, you asked me a question and I meander all over the shop. So got to watch out.
It's great. I think the reason I ask is because what's admirable about you and someone like Warren Buffett is that, first of all, they're authentic, but in the case of Warren Buffett, he's consistently, or at least been around the S&P for 30 years, which is incredibly hard to do. And a lot of people aren't aware maybe of the fact that they can do that themselves and are trapped by people who are charging them fees and whatnot to underperform the market. And so it's refreshing to hear it from somebody like you, in the sense that you are upfront about how people should be at matching performance of the markets and whatnot. And so that's why I asked.
I think that it's increasingly, I realize that in life, the indirect route is the best route, which seems so strange, and I will do my best to explain. So, the direct route around kind of trying to get good investment returns would be to kind of like, look every day for the right investment, to do an enormous amount of analysis, and that becomes unsustainable very quickly. And so, being able to pace yourself. So how do you pace yourself? Constantly creating, and it operates on multiple levels. The friends one picks, where one lives, where you put the Bloomberg monitor, if you have a Bloomberg monitor, which companies you have in your universe. It goes on and on and on multiple levels, but you're constantly trying to bring your world into one where you're more likely to make the kinds of decisions that are going to enable you, are going to enable me to get out those kinds of results. So I'll just give you one very, very simple, and it's just one of many, many, many building blocks, is I know from many different data points that the probability that if I trade in the portfolio, that is going to enhance my returns is extraordinarily low, actually. The vast majority of the time when we make portfolio moves, they're going to not be good portfolio moves. And so, I need to find as many ways as I possibly can to prevent myself from trading. So, that's point number one. So how do I do that? Don't open up the Bloomberg monitor too often. Don't check the portfolio too often. We've looked at that. You held up Fooled by Randomness. There's a wonderful analysis in that book by Nassim Taleb of how a market that is up on average 10% per year is going to be up. If you bring it down, so the market is up 10% per year, I don't know, 70 or 80% of the time, I think, if you look at history over the last 100 years. If you now look at if the market is up on a quarterly basis, that goes down to 55% of the time. If you look on a weekly basis, it's 51% of the time. If you look on a daily basis, it's 50.000. So we know that we experience an asymmetric reaction to whether our portfolio is up or down. So the more often you check your portfolio, the more likely it is you're going to have a negative reaction. The negative reaction is going to make you feel bad, and that could spiral into taking an action that you don't want to take. So don't check the portfolio too often, and then put yourself into businesses, invest in shares of businesses where, pretty much, all the kinds of things that you would make somebody like me fearful and want to adjust are not going to make me do that, because they're sufficiently strong, high quality businesses, all of those things. So, but there could be 1,000 other things. It could be that when I talk to a certain investor of mine, it makes me scared stiff and makes me want to sell the portfolio. So maybe I'm going to try and find a way to speak to that investor differently, or maybe try and not encourage that investor to be an investor in my fund. So the way you get the results is by creating. It's not by trying to be the smartest guy in the room. It's kind of, and just to, I can meander all over places. Another analogy, which is a really fascinating analogy, is, so there's a word for this. It's not ergodynamics. This is, if you put a guy in a cockpit to fly a fighter jet, the design of the cockpit is a study in, it's a word that I could look it up, but I'm not going to. It's a word like ergodynamics. It's about designing the information environment. So the guy sitting in that jet, and he has to make decisions based on incoming information. And the designers of the cockpit need to structure the information, both in terms of where it is visually, but also how quickly it comes into him, where he has to look to find it. Is he looking lower left or upright? Is it flashing red? Is it flashing green? Is it a big red? Is it a small red? Is the dial big or small? So they design that information environment to optimize for certain tasks and to reduce the probability of mistakes and to increase the probability that they get the mission completed according to specification. So in a certain way, what I'm describing about how often you check your portfolio, what's in your watch list, is actually kind of designing my cockpit, if you like, putting together the environment that will help me make the best decisions. So rather than don't try and overcome your environment, design your environment for the best possible results. And that might be, for example, when we visited Warren Buffett's office, Mohnish and I, for a couple of years after we had lunch with him, when the Berkshire meeting was on, he invited us to Kiewit Plaza, and above the door, in one of the rooms close to his office, he had a sign that said, "Invest like a champ today." And it's from some basketball team where they had a sign that said, "Play like a champ today." And that is just a visual reminder of what we're doing. And so that was really telling for me, because what that said was that, I mean, just forgive me, Trevor, think of that for a second. You got one of the greatest investor in the world, and he's made an enormous amount of money. He's extraordinarily successful, but he saw it fit to put a sign in his office that said, invest like a champ today. If that's what he puts in his office, what should we be putting in our offices? Where are we? You get the idea. So that, by the way, is part of the benefit of visiting somebody that you admire. You'll pick up, it's also the conversation and all of those things, but it's also just those things that you see in and around them. Back to you, Trevor.
Kind of like the too hard pile Warren Buffett has.
There's a box. There's a box in his office. There's too hard. It's a reminder. Some things are just too hard.
Mm-hmm.
It's a great point. But so he's structuring his physical environment in a certain way.
Mm-hmm. How important do you think it is to live in a quiet place where you can think independently? For example, Warren lives in Omaha, and you live, I think, part-time in Switzerland.
Yeah, that's interesting you say part-time. Our 3 children are currently at school in the UK, and so we spend a lot of time in the UK. And so I think that, Trevor, it's less, I think that I would attach less importance to it now than I did when I wrote the book. When I wrote the book, I was very focused on structuring the physical environment. And I'm not saying that the physical environment is not important. It certainly is. And to have that sign over the wall or any of those things is certainly a good thing. But I think that the even more important than the physical environment are the relationships that you have. So I think in my case, I had a bunch of unhealthy relationships in New York City that would have been hard for me to break off had I stayed in New York City, or not impossible, but would have taken work. And so I think that hitting the reset button and taking a complete break was valuable for me. But the fact of the matter is, Ruane Cunniff and a whole bunch of other very successful investors live in New York. But I think they're part of very different social groups to the less successful investors. And so I actually think that I'm very influenced by this guy, Nicholas Christakis, did some amazing work. He's a professor of medicine and a doctor at Yale University. And he did work on human networks and how they impact health. And he had this amazing, and I think there's real power in what I'm about to say. So pay attention. What he discovered was that there was a kind of contagion to obesity, was what he studied. And if you were in a network of people, and I don't know how in the study he judged whether you were in or not, whether you were in a network or not, but basically the people, if you had obese friends, you were more likely to be obese than if you did not have obese friends. And the key point there is that it's not the people you go to work with on the T or the people you're on the bus with. It's the people that you're in social networks with. And if you take that, and by contrast, people who tended to be fit or even of the right weight, we're in networks of people who are of the right weight. So what is that? What is the transmission mechanism? Well, if I got overweight friends, perhaps they're more likely to be couch potatoes and invite me over to watch the ball game on a Saturday or a Sunday afternoon for 3 hours, eating crisps and drinking beers. And if I have I'm in a network of fit friends, they're going to be, hey, when you're coming cycling, when you're going skiing, we're going for a hike, so there are transmission mechanisms that are through social interactions. There's extraordinary power in that, because that means that, you and I, who we have in our life is destiny. And by simply making those choices of who we want to have in our life, we can change our destiny, we can change our health, we can change our weight, we can change our investment returns, I believe. Mm-hmm. So that is a huge part of why I, for example, attend the Berkshire Hathaway meeting every year. I want to be in that group of people. That is also a huge part of why wherever I am, we are in the world as a family. We've joined a religious community, in our case, a synagogue. And it's not like, the religious communities are the very best on the planet at everything. But I think that, you know, my children, my family is more likely to have the right morals, the right ethics, the right approach to life if we decide to participate in one of those communities simply through this kind of osmosis, if you like. So, so yes, I did move to Zurich. I think one's physical environment is important, but I think that proximity to friends and family, people who share the same values, is more important, actually.
I think one of the fancy terms is the 5 gyms theory, where you are the average of the 5 people you hang out with.
Yeah, one of the guy that I used to listen to him a lot, John Lee Dumas, Entrepreneur on Fire, says that at the end of every podcast, actually. And so, you know, and I used to play John Lee Dumas podcasts when we were driving around with our children when they were younger, because I wanted them to absorb some of that very positive energy. So,
I don't know how much time you have. I think you said an hour stop, but I have a lot of questions if you have the time, but if not, that's fine.
Should we do another 10 minutes? How's that?
That would be awesome. I really appreciate it.
Yeah. I'm gonna, you know, so I hope you'll forgive me, Trevor. I have some tea here, English breakfast tea. I'm just gonna pour it. It's been brewing here. So let me just, I'm a male. I can't run and chew gum at the same time.
Yeah. I'm not sure if you can hear my dog barking either, but we have two Labradoodles and they go crazy. So.
Oh, lovely.
I'm trying to ignore them.
Don't worry. It's all good. There we go. All ready to go with my tea here. Cheers.
Cheers. You're known as a value investor. Maybe that's how you started out, the approach you took. Would you still call yourself a value investor in the era of tech stocks and software and everything else, or have you evolved into buying good businesses?
Well, in my way of looking at it, and I'm not saying anything that's new or original, all intelligent. Value investing is intelligent investing. Intelligent investing is getting more than what you paid for. And so I call myself a value investor, but that's because I think of myself as an intelligent investor. And I don't actually know where the term value came from, because if you think of the origin of all of this, it was Ben Graham. He didn't call it the value investor. He called it intelligent investor. So for me, those two terms are interchangeable. You know, I think that a dichotomy between value and growth is not a useful one. It's not a useful way to categorize the world. Again, a low-growing business could be a good investment, and a high-growing business could be a good investment. And so that's not really worth thinking through too much. I think that perhaps if I can recast your question into something that is kind of a burning issue for anybody who takes investment seriously, is that there's a whole class of companies out there that have either done an Amazon or want to do an Amazon and or are claiming to the world that they're doing an Amazon. And by doing an Amazon, what I mean is to be a company that basically shows no profits for more than a decade, invests massively in multiple businesses, has somebody like Steve Ballmer says, well, a company's got to make money at some point, and Amazon hasn't yet made money. Or a Mr. Guy Spier, who, partly encouraged by Steve Ballmer's comment, says that Amazon may be the only company or the first company in the history of capitalism that never that never paid a dividend. It will just go through this huge bubble cycle where everybody thinks it's worth so much, and then eventually it will turn out that they've spent so much money on so many things that there's no money left, and they will have recycled all of their money into projects that earned a low enough return that the investors ended up not making any money. But boy, it was a hell of a ride in the middle. How wrong I was. The fact of the matter was, Jeff Bezos through some combination of smarts and luck, took pre-tax profits, perhaps pre-operating income profits, and diverted them into very, very high return investments that resulted in the company not showing profitability for the longest time, and then suddenly becoming a cash machine. And but today, there are dozens, if not hundreds, of companies that are following a similar playbook in which, the terms of analysis are: what is the unit economics of this business? What is the cost of acquiring a customer? What is the lifetime value of a customer? What is the total addressable market? And if you have a large addressable market and you have a good ratio of lifetime value of customer to acquisition cost, you can just go off to the races, not declare any profits, and say it's all going to happen down the road. And I think that a dichotomy that there is that I think that at the end of the day, people like me, my question is, if the business is so great, then why can't you show some profits to the investors today as you march on to this fantastic future and nirvana? And the people who invest in those kinds of businesses say, well, that would be a shame because the unit economics work, and therefore they should spend every last penny going after total available market. So you have businesses that you live in a world in which 100 times revenues like Snowflake is not impossible. 10 times revenues might be cheap. And if I, as somebody who's trying to learn, ask the question, look, the unit economics seem to work today, but will they work in 10 years' time at the point at which they're profitable? Maybe the economics would have changed and it doesn't work anymore. They kind of roll their eyes at me and they just say, oh yeah, you're one of those dyed-in-the-wool old world style. We don't need profits anymore, at least not currently. And so in that sense, I think that I'm still very much on the side of, quote, value, having redefined that dichotomy, in that I don't think that I will ever, I think it would have to be extraordinary for me to pay more than 10 times revenues for a business. And I do have a big problem paying for a business where there just seem to be no profits year in, year out. And I think that some of those will turn out to be Amazons. They really will. And you can make your bets about which ones those are. But I think that many of them won't, So
maybe a slight nuance to your thinking. I think it was Karl Marx did one of the 2 or 3 memos ago. It was something of value where he got into his evolution of thinking with his son and on software and tech companies, but maybe not a total 180, just a slight change in thinking.
Who was this?
Karl Marx. It was 1 or 2 memos ago. It was
yeah, I vaguely remember that memo. And his point is, which has to be well taken, is that the world is changing.
Mm-hmm,
and
exactly.
There are many Amazons around. And so in my most recent letter to my investors, kind of like, on the one side, I kind of speak out of both sides of my mouth, because on the one side I disparage it, and I've been kind of disparaging. And on the other side, I concede and say, but the world has changed, and therefore I need to engage with this. Mm-hmm. And so, I don't think there are, I don't think it's hard for anybody listening to this to not come to the conclusion that there aren't any easy answers. And because, as Charlie Munger said, if this was easy, everybody would be doing it. It is hard, it is difficult. All of us, some of us who've gone and bought shares of Alibaba, is the company going to get ripped apart by the Chinese system? Are the Chinese going to respect all of these foreign investors who are invested in Alibaba? Who knows? These are difficult questions. Should you have more of your money in your home market? Warren and Charlie differ on that. It's not like Warren doesn't understand Alibaba, but he's not putting a big chunk of Berkshire Hathaway's money into a Chinese company. Isn't that interesting? At least not these days. He did when they invested in BYD. But so yeah, I don't think there are any easy answers. But just the category value versus growth is something that, there's a lot of quote investment advice and analysis that is, well, there's a lot of people who want to generate fees, and what masquerades as investment advice and analysis is a way to generate fees. So, you need the category value versus growth to enable the broker to call up the client and to say, a lot of our clients are rotating from growth to value, and we think it's a really good move because A, B, C, D, F, G, and would you like to rotate yourself, And so we need to be aware that a lot of what is written about, I mean, forgive me, it's a pretty basic thing, but I say it in part to remind myself, the person writing what they're writing or the person saying what they're saying on television may not themselves be aware of the underlying goal that they have. And it took me a while to understand, and here's a wonderful one. So there's some fairy tale of Chicken Little. Chicken Little is constantly afraid that the sky is going to fall onto his head. There is a wonderful, hilarious genre of investing, which basically you write to your investors and you say, dear investor, the world is about to fall apart, or Japan is about to fall apart, or the Japanese yen is about to fall apart, or the Hong Kong dollar is about to fall apart, or we're about to fall off a cliff in the United States with a debt overhang, something. And this writing is really good, and you genuinely scare the Jesus out of the reader. And somewhere buried in that letter is, or maybe not buried, maybe it's right up front, is it says, and because I'm so smart and I've been so good at telling you about this, the real way to play it safe is to send me your money, Or a slightly easier version of that is, and if you want to hear more, buy my newsletter, check it out. It's only $2,000 a year. And, that's nothing in comparison to what you might lose. And, there's a guy, I've never met him. I've read his newsletter once or twice, and I've said this before. And so if the listeners heard me say this before, forgive me. And if you're Mark Farber, forgive me, Mark, but it's such a beautiful example. The doom, gloom, and boom report. You got it right there. And I'm sure it's an extraordinarily successful newsletter. And here's what's actually also interesting about that is that that kind of sentiment, even in the three words, doom, boom, and gloom, are kind of viral. It makes people perk up. Those words make people pay attention. And what I've actually done, Mark Farber's probably, if it's still published, I don't know if it's still being published, he's enjoying it very much because I've just promoted his report. And so there's this kind of phenomenon that there's certain kind of phrases, news, art, or styles of communication that are viral, that get around. There's a great phrase, the lies have traveled twice around the world, and the truth is still putting on its boots or putting on its underwear. And what's my point? We need to be aware that when somebody talks about value versus growth, what is driving them to do that may well be that they want to find a reason to convince people to shift their portfolios around. So I painted a very stark and colorful picture of somebody who has a newsletter business, but it may be more subtle than that. So
what's the quote is, the guy at the fishing store doesn't sell tackle to fish.
Yes, it's a beautiful one. And I just want to repeat it for the listener. And, I kind of like, the listener might be sitting in their car somewhere, driving somewhere. They don't have the ability to look it up. But the guy takes out this really kind of colorful piece of tackle, of fishing lair. And he says, and he's like, wow, check this out. It's all bright and it's got jingles and bells and all sorts of things. He says, will the fish go for this? ? And the owner of the fish store looks at him and he says, I don't sell to fish. Beautiful idea.
Well, along those lines, I guess another question I had was, it seems like everyone is on the path to get their CFA and MBA, if you're trying to pursue a career in finance, with everyone learning the same thing and studying the same subjects, do you think it's possible to outperform the market, or is it better to spend your time learning on your own and trying to come up with novel ideas?
So here's the analogy that I want to give you that I hope you like it, because I like it. And I think it's useful. So if my goal is to climb Mount Everest, and we all have different Mount Everests in our life, we all paint that mountain slightly differently. And I'm considering it like, what is the Mount Everest? I'm using it as that's the sort of the BHAG, big, hairy, audacious goal for all of us. And it might be, I want to be a billionaire. I want to get married and have children. I want to have a PhD, be a professor. Who knows what it is? But I put myself, and I'm kind of embarrassed because I've not read any of the biographies of Sir Edmund Hillary and Tenzing Norgay, who climbed Everest for the first time. But I put myself into his shoes, which, by the way, is a very effective thing to do. In my book, I talk about how I sort of like put myself into Warren Buffett's shoes. So, Trevor, there we are. We're in Kathmandu, and we're kind of scouting, and we know we want to climb Mount Everest. So talking to local guides, definitely a good thing to do. What's the probability that you and I would become expert ice climbers? Pretty high. That's a really important skill. There's a lot of ice walls there. Definitely good to know how to climb ice. What's the probability that we're going to visit pretty much every mountain climbing store on the frickin' planet and look at all the tools and all the equipment, and we're going to become experts in the equipment? We're gonna that's just going to become one of the things that we do. Why? Because you want to do this big, hairy, audacious thing. You're going to pick up everything. You're not just going to pick up every tool that might be helpful. You're going to visit every place, talk to every person. You're on a quest. You're on an adventure. You're going to go find whatever it is that is going to help you to succeed. So when one looks at that context, and then one says, if I just push the analogy, and let's just say that an MBA or a CFA are different versions. One is, there's a climbing and mountain goods store here. There's a chain of them called Bechley Sport, and in the United States you've got Eastern Mountain Sports, and then you've got one on the main road here, Bahnhofstrasse, called Ochsport. And now. You asked me the question, do you think one should visit a mountain climbing store? And if so, which one? And I think that my answer is, well, shoot, maybe you have all the knowledge that you need on all the equipment that you would need to get from a mountain climbing store, because all of that only gets you so far. So maybe you don't need to go, but you know what? Why not, actually? Maybe they got some new stuff there. Maybe you'll learn something. Maybe you'll meet somebody who'll help you to climb the mountain. So my answer is all of that is extraordinarily useful. Even Warren Buffett saying that Harvard Business School at the end of the day would have been not as good as Columbia Business School, because Ben Graham was teaching at Columbia, not at Harvard Business School. Mm-hmm. At the end of the day, you go to where you're. My answer to somebody who's like, should I go get an MBA, is, if you have a better option, if you can show me a compellingly better option, do that. But if you don't, then why not? And it's not good enough to say, oh, I have all the knowledge in my head, or I can learn it all on my own. That's a bit like the guy, Sir Edmund Hillary saying, oh, I'm not going to go to the mountain climbing store. I can make my own carabiners. No, you idiot. Go to the mountain climbing store and see what the best carabiners are. Go talk to the salesperson. Find out who came and sold them carabiners yesterday. Find out who's bringing carabiners back that have broken, So my answer is, if you have something that's compellingly better, go for it. But if you don't, go do an MBA, go do a CFA, go acquire it all. Don't assume you know better than what's useful and what's not. Yeah.
How do you spend your days? Is it reading, kind of like Warren Buffett does, or is it analyzing numbers and crunching spreadsheets? Or in the case of, I think it was Naval Ravikant, he said the best investors go for walks and read all day. What do you do?
So that's an evolving process that I feel like I'm actually making some significant progress on and getting better at. So there's something I read somewhere. I really wish I could attribute it because it's such a valuable phrase for me. It's been in my head for a while. Close open loops. So, you know, I work on the computer and in the physical world. I print out a lot of stuff, but I'm very, very influenced by some of the people who've talked about personal knowledge management systems. Two very interesting, two or three very interesting people. A guy called David Perel, who's written about writing, and he's got some courses online. A guy called Tiago Forte, somebody called Sonke Arons, who writes about the settled custom system, and somebody called Anne-Laure Leconf that I kind of came into contact with at the beginning of lockdown. They're all kind of, you can find them on YouTube, you can find, they have websites, they have email newsletters, and they're all kind of working at different aspects of the personal technology stack, if you like. And and then just to add one thing in there that I think is extraordinarily valuable is the concept of spaced repetition. Mm-hmm. So my understanding of spaced repetition is that in order to learn something optimally well, when you don't know very well, you have to repeat, or you have to go back to it often. And the better you know it, the less frequently you need to go back to it. So the better you know something, so you need less frequent refresh. So you know, I'm effectively learning about the world. So I'll come across a company, I'll print out the annual report, and I will read it. Then I might take notes on one of 3 different places that I take notes regularly. I take notes on something called Rome Research, which is a wonderful piece of software. I take notes on Evernote. And then I sometimes, more in writing mode, I use a piece of software called Scrivener. And then I might write notes on the actual annual report, and and then the third place online is Bloomberg has a notes function, and I do use Bloomberg far more than I used to. And so those create all open loops. And now I have a system so the physical notes I will put in, and I'm looking at the place where it is in my office here. There are shelves which are called sometime, soon, and now. And depending on when I want to reloop it into my consciousness, it'll go into sometime, soon, or now folder, or not a folder, but a shelf. Similarly, I have systems online for reviewing the stuff that I've looked at. And you can see how I'm kind of creating a sort of a spaced repetition process for absorbing and reabsorbing and thinking again about the world. Now, at the same time that I'm doing that, I'm writing notes. I'm sometimes sharing those notes with other people online or through an email. And I'll send a group of people an email about something that I noticed and I looked at. So, you know, that's just a little bit of a window into my evolving personal knowledge management system, which is about saying I'm going to create the time to look at things. I'm also going to create the time to think about them. And then I'm going to kind of set my future self up for an opportunity to re-engage with this particular topic. And, you know, with the expectation that most of the time I'm doing nothing. In terms of managing my day, you know, I've learned that the best time for me to do exercise is first thing in the morning, because willpower disappears very rapidly after that. I try as much as I can to do in-depth reading in the morning, because my attention span declines through the day, and I find it harder to absorb new material later on in the day. So I ask my assistant to block out time in the morning for me to just kind of do hardcore reading. And you know, and then the day is punctuated by calls. I try to do as few calls as possible, not, you know, in contradiction to what I wrote in the book. Speaking to management is extremely important, that is 180 degrees different to what I wrote in the book. If and when I do a second edition, that's one of the first things I'll go to, is to rewrite that and to explain why that's not the case anymore. But yeah, so there's a little bit of insight into how I work.
That's awesome. I think it really helps to paint a picture on what a top investor does for anyone that is listening.
It's kind of you to call me a top investor. It doesn't feel like that. And that brings up something for me that, and this I think will be valuable for the audience, is that so imposter syndrome is a real thing, and I spend a huge proportion of my life feeling singularly unsuccessful and feeling like the portfolio ain't doing much, and so it's what is it? A watched pot never boils. The pot only boils over when you turn your attention to something else. I think that doing this right, my experience of it is it's a bit like watching grass grow. And so if any of you guys listening to this are feeling like you're just watching grass grow, then you're probably doing something right. In a certain way, intelligent investing is about an inner scorecard in which you're not receiving validation from the world. That's why your investments that you're buying are going to work out, because they're cheap. Because if it was the kind of thing that if you do it, you get an enormous amount of validation from the world, everybody's going to be doing it, getting that validation, encouraged to do more of it. And therefore it's not going to be cheap and it's not going to be good investment. So, if I buy shares of Snowflake, oh my God, I can get into all these online forums, talk about Snowflake this, Snowflake that. It's so wonderful. It feels really, really, really good. Whereas there are other investments, I remember one of the first write-ups I did was for this, you might know the company because it actually was owned by a Canadian guy, Weetabix. It was a Canadian family that owned it, but Weetabix is an extremely well-known cereal in the UK that tastes like cardboard to everybody else, but Brits love it, and it's got a very high market share. It's a very simple product. It's a very powerful brand. It's a bit like Marmite, only the Brits eat Marmite, and even the Australians, they have their own version of Marmite. And, so for the listener, Marmite is this thick black paste that is made with a high amount of yeast and yeast extract, and looks like chocolate, but isn't. It's savory. And Brits spread it on butter, on toast, and love it. Australia has a similar brand, also a similar product called Vegemite. For those who like Marmite, and I like Marmite, Vegemite tastes disgusting. And to the people who like Vegemite, most of them, Marmite tastes disgusting. And for people like my wife who didn't grow up with it, they're both equally disgusting. But Weetabix, I do this write-up on Weetabix, highly profitable company, extraordinarily cheap, no debt, run by a family, extremely well run, and trades at 4 times earnings. I bring it to this Posse investment group, and I think this is the best idea since sliced bread. They were completely uninterested in it, didn't give me any validation. And for some reason, I had the temperament to be able to say, yeah, well, I don't mind, I'm buying it anyway. And 5 years later, it was bought out at 3 or 4 times the price I'd invested in it. It was an extraordinarily successful investment. Don't expect to get validation. So if you want to do this successfully for a long time, you want to buy investments that are going to work out, you need to buy them cheap. You're not going to get validation for what you buy unless it's from a very small group of smart people. And even that you shouldn't trust. And find a way to continue to live, be happy with yourself without that external validation, because you're not going to get it.
In terms of skin in the game, do you have a lot of your money in Aquamarine funds still?
Well, that's hilarious that you should ask that. I mean, if I didn't, you shouldn't be talking to me. Mm-hmm. That's kind of a be all and end all. I mean, that's absolutely put your money where your mouth is. I run, a very significant proportion, 98% of my net worth is in the fund. Perhaps slightly less than 98%, but not by much, because we bought a house recently. So, but up to then I was living in a rented house, and it feels good to own a property. So it's not 100% in the fund, but, and, I and the family group make up a very substantial portion of the fund. Yeah, absolutely. Absolutely. Otherwise, you shouldn't be talking to me. Like, what the hell?
I learned that from Nassim Taleb, but also maybe you kind of pick it up throughout the years. If you read enough about good investors, always seem to have their own money in their own project.
Yeah. And a good way to look for businesses is owner managed. And so well, Amazon would have been an example. Berkshire Hathaway would have been an example. There are a few of them around.
Do you still pursue a model of only getting paid when your clients make money, the Buffett partnership model, where I think it was 6% hurdle rate and then 25% of the profits afterwards?
Yeah. So the majority of the money is in that. So I did not. I came to the launch with Warren Buffett, and I didn't want to be a high-paid fund manager. Until that point, I did not have that arrangement. But what I did was, and I think if somebody who's setting up a fund who wants to change the compensation arrangement for their investors, no investor likes the deal changing, even if it's changing to their benefit. They just don't like it. It makes them very uncomfortable. So what I did was I created new share classes which had that fee arrangement. And so many of the early investors are still in a fee arrangement that pays a management fee and a performance fee. Most of the subsequent investors go for the share class that only pays a performance fee a la Warren Buffett's 0, 6, and 25. Just that I should be wrapping it up now.
Okay, we'll wrap up. I appreciate your time.
Yeah, Trevor, it's I thought you'd going to be talking to me about coffee. And it turns out that because your website kind of talks about coffee, it's not just about investing. And so I think that we should wrap it up with a brief conversation, like 2 or 3 minutes, just about coffee. And tell me about Rose Brothers Coffee, just briefly.
To make it quick, Rose Bros Coffee is primarily distributed online, Amazon.ca, Amazon.com. So from Alaska to Florida and everywhere in between, and just a fun entrepreneurial business that we started. So
I thought maybe you'd be interviewing me from your roasting operation. Do you have a roasting operation?
We do have a facility that we use to roast our beans. We do a light, medium, dark, espresso, and decaf.
And so how did you end up doing a podcast on investing and coffee?
We always wanted to have an entrepreneurial venture, but I can hear my dog.
Yeah, no problem. The listeners are going to love it.
It's a live experience, but I've always been interested in value investing. I've read most of Buffett and most of Charlie Munger and all the others, and so it kind of just meshes on the podcast. So
that's so interesting. I have some version of ADHD, so I think on some level, I drink coffee to self-medicate, but I don't like single origin blend, or they're not blends, single origin coffees, but I just like espresso blends. I love my coffee machine. I have a La Marzocco GS3. I don't have an investment in the company, but my life is made so much better by the coffee that I have in my life, and I really enjoy it. Both espressos and cappuccinos I do a lot of, and it's nice to talk to. Now, are you just a seller of coffee, or are you a coffee fiend yourself?
Oh, I love coffee. I'll drink it all day. Yeah.
Until what time?
Oh, that's a good question. Depends how I'm feeling. Like 3 or 4 o'clock, maybe 5 if I'm pushing it.
Yeah, that's the same with me. And how many a day?
3 or 4? Maybe
3 or 4.
Yeah, it depends.
Espresso?
Pardon?
Espresso?
Yeah, I'll do espresso. I prefer dark roast. but
espresso extraction method.
yeah, right. Well, AeroPress in that sense, actually.
Oh yeah. That's Andrew Wilkinson of Tiny Capital bought
Yeah.
that company, and they're an interesting group of guys out of Canada as well, Victoria. I just had some contact with them, and they're an amazing group actually.
He's trying to do the internet version of Warren Buffett, from what I understand. So
Yeah. I think you'll have a very good chance of success. But, hey, Trevor, such a pleasure to meet you. Thank you so much for taking the time. I enjoyed meeting you. If I was in North America, I'd buy you a coffee, but I'm not. But if you like this podcast, sorry, I'm kind of taking over the host role. I hope you don't mind, Trevor.
No,
if the listener liked this podcast, go buy Rose Brothers coffee. And if you liked anything I had to say, then just find me on Twitter at Guy Spier, and it all flows from there.
Awesome. Well, we will wrap it up there. Thank you.
Great to meet you. Thank you.